Today's video is about ICICI Multi-Cap Fund. So it is in existence from 1st October 1994. The present fund manager is Shankaran Naren. So he has been managing this since August 2022. So just over 2 years, 2.5 years is the time now. So there is an exit load of 1% if you are redeeming before 1 year. But ideally, like I have said before, so any equity investment, the minimum time horizon has to be 5 years. If somebody is investing with a 5 years time horizon, then this shouldn't even matter. So the benchmark they are using is Nifty 500. The present AUM is 14,283 crores. If you look at the direct expense ratio, it's at 0.98%, and the regular is at 1.75%. So a distributor would be getting approximately around 0.7%, 0.6 to 0.7%, and an advisor, if he or she is charging around 0.6% plus GST, will end up charging something similar like whatever a distributor is charging. So again, when you are paying for a advisor or a distributor, you have to make sure that the advisor or the distributor is helping you with the goal planning, asset allocation, and they have to give you rationale why he or she is recommending this fund. At the same time, they have to help you with your risk profiling, even the performance tracker, etc. Right? And when you are choosing them, you have to make sure that they are willing to get in touch with you regularly, at least on a quarterly basis, so that they will understand the changes in your financial situations, and at the same time they'll be helping you understand with the changes which are happening in the market. Say for example, in the last 6 months there has been a lot of drawdowns. So a advisor or a distributor who talks to you regularly may help you understand why you have to stay put during such times, and probably help you why, maybe in case of maybe he or she will explain you why you have to put in more money during the drawdowns, or else at least if you are not putting in more money, at least why it makes more sense to stay put in case of drawdowns and not exit, right? If somebody is fitting all these boxes, then there is no problem if you are paying that extra amount. Otherwise, it's better you do it on your own. You have to, again, in order to do it on your own, you have to understand the thesis of the fund, and you have to understand if that is fitting to your thinking or not. Now let's look at the analysis, how this fund has done across time horizons. So again, the first 3 years, it's not of much relevance. But if you are looking across 5, 7, 10 years, the direct fund has outperformed, all the indices. But if you look at the difference of performance, the regular has done okay from on a 5 to 7 years, 5 to 10 years horizon. So sometimes Nifty 500 has done better probably. So but if you look at the deltas, right, say for example on a 5 to 10 year horizon, approximately the direct fund has done around 14 to 17.5%, and the regular is around 13 to 16%, right? But in the similar horizon, if you look at the Sensex, it's around 12.5%. Nifty 50 is around 12%, Nifty 100 around 12%, and Nifty 500 is around 13.5%, right? The additional amount which they're adding is not huge. And if you look at the number of negative instances as well, so on a 5 year horizon, from 5 year horizon onwards, on a direct side, there are no negative returns only, but on a regular side, there are small number of negative returns, that is around 0.32%. So this is the regular is comparable to the Sensex on the number of negative instances. The direct one has done slightly better, right? But if you look at the overall fund performance, the fund has delivered like 1 to 2 percentage points higher return when compared to the index, especially when you are comparing with the regular on a 5 to 7 year horizon. The difference is not much, right? 12.64 to 12.83 against this 12.76 to 13.68. So if any advisor or distributor is recommending this fund, they are pretty much, the performance would be in line with the Nifty 500. Whatever you know extra this fund has made, uh, when direct is compared to the regular, so the extra is going off basically to the distributor or the advisor. So you have to make sure that they are working for you on other different aspects. So now let's look at the portfolio, how the churn has been in the last 10 years. So since this is a multi-cap fund, so what I have done is, like, I have not the time horizon, I have not taken exactly the entire stuff. So rather what I have done is, few here and there just to check to check the churn. I have taken few less than 1 year horizons as well, just to show how big the churn was. Say for example, January, right? So whatever was there in January. So if you look at it, approximately there were 27 stocks in January 2016, and the total amount was 91.45%, and the remaining was in cash. So if you look at the January 17, what has happened in 1 year? So there was like almost like a 70, close to 60% of the stocks were taken out, right? And if you look at what has, compare this with what has happened in January 17, so let's see what is there in January 18. So in January 17, the number of stocks are like really very high, probably. See, overall the count is at 46 and the sum is at 94.19%. So, but if we are looking at the January, that is at 47%. Again, 47% of whatever was there in January 17 was taken out, right? So, if you look at February 2021 and see how was it comparing with the February 2020 and February and this one. So, 98% of the fund is invested, right? And there were in 56 stocks. So if you look at the same thing, the same number of 56 stocks, right? The total sum is at 95%. So again, there is a churn of 45%. So this fund is actually churning a lot, right? So even in February, if you are looking at it, compare with February 21. So compared to February 21, let's 1 second. So again, here as well, it is at 83%. Like somewhat like only 15% of churn was there. This was probably the first year where the churn was low. But if we are comparing with February 22 and looking at December 24, where do we stand? Right? 98, close to 98% of the fund is deployed. So, and if you are looking at February 23, this has come to 62%. Again, probably one probable reason would have been the change in the fund manager. But from February 22 to 23 to February 24, right? This is at 50%. So from that there to December 24, this is come to 47%. That means like there is a huge amount of churn. What happens with the huge churn is you know, one reason why some of the returns, see, huge churn will lead to huge costs because there will be brokerage costs and all the other costs which will be there. So when you are churning your portfolio a lot, what happens is you will end up with good amount of brokerage charges and all that stuff. And the other thing is like when the stocks are approaching more than 50 in number, so the performance of the fund will move closer to the index, right? Now, at this point of time, they're having in December 2024, there were 87 stocks, and the same number of stocks were having 72.64 weightage. Compare this with to 96%. So again, there is a 25% kind of churn. So this fund had a huge amount of churn, right? And at the same time, the number of stocks were high. So probably that's one reason why its performance is closer to the index. So the index overall is having 500 stocks, and when you are in 86 of those stocks, then most likely, the performance will change. And there is something called equity less than 1% of the corpus. So here again, there will be good number of stocks as well. Let's look at the performance in different time horizons from 2014 to 2018. So Nifty 500, so in this 5 years horizon, gave 86% of absolute return. Compare this with the regular fund, it was around 128% direct fund, and the regular is at 118%. So in this period, they have given a decent amount of significant outperformance if you look at it, right? Um, and 2019, if somebody has invested in 2019 January, right? So probably till this point of time, till 2023, the 4 years, it was pretty much flat if you look at it, right? Only the performance has changed from 2023, uh, April onwards. There is some amount of divergence, but it's not huge. Okay. So from that point of to till here, 2019 to present day, in the 5 years, the absolute return has been around 169%. Compare this with 131% for Nifty 500, right? And if we look at if we consider it till 2023, the performance is pretty much similar. So again, even the drawdowns are also something similar in a similar fashion. So from 2014 to today, like if you look at it, the drawdowns are in similar pattern, and even the fund performance was something. There is not a huge amount of divergence. Right? It was pretty much probably mimicking the index as well. Maybe they are changing the weightages here and there, but if you look at it, it's not a huge amount of outperformance, I would say. And let's see how things have changed after the change of fund manager. So obviously the fund manager will take some time to churn the portfolio and everything. So after 8 months of time, there is a decent amount of outperformance. But again, this is a very short term time, because since the time the present fund manager has taken over, it's just been 2.5 years, right? And he happens to be a ICICI Prudential CIO as well, and he's a very reputed fund manager, right? But this fund overall, it has done in line with the index, is what I feel. So this video is for educational purpose only. It is neither a recommendation to buy nor sell the asset class in discussion. So for any equity investments, one thing you have to remember is the time horizon. And the second is you have to look at the risk profile and if this fund is suiting you or not. In case you have an advisor or a distributor, you have to talk to them and understand why this fund is suitable for you. And you should always invest basis your asset allocation and in line with the priority, in line with your goals. Thank you.